This week in economics from WBRN Radio and on the Bostonred Network. As normally is the case, this is a collaboration between WBGN, the Bostonred Network, and Cranston Analytics. We're on the 10th of February 2019. We'll first present some anecdotal evidence here, and then we'll zoom in on some other factors from the supply chain people out in Mesa, Arizona. I believe we have their data set here. But what's sort of interesting here is the number of winds, crosswinds, whatever you want to call them, are blowing all at the same time. The Chinese economy, whereas the GDP is lower, but at the same time there are positive developments, as there always are. Looking at it dialectically in China. So when we look at China and where they are going, but there are also trouble spots in the UK with Brexit. The idea at the end of March, if there is no Brexit, they have an alternative, literally a transport mechanism to get transport literally from the UK to France. But the company and the whole plan itself was premature. In other words, as my old friend Jeannie Lyles would say, it's a mess. And she was from North Carolina. So thus, that is a problem. And in France, we have demonstrators in the streets. By some estimates, up to 100,000 of the so-called yellow vests demonstrators, the Gilets jaunes, demonstrators there demonstrating against the government of Emmanuel Macron. Anyway, those are some of the spots. And then, of course, here we have, in a week or so, we could have a shutdown. And I used the we in the U.S. If the negotiation does not bear fruit, there's a committee of legislators that are supposed to, or at least attempting to bring that out with the chief executive, DJ Trump. And also in the Americas, we have the situation with Nicaragua. The U.S. is trying to overthrow the oil-rich government in Nicaragua. And that has caused a disruption in the energy sector. Tankers are setting in various places in Texas and other places to unload their wares because of the medium and heavy crude that you get from Venezuela. Venezuela is their reserves are some of the largest, many say the largest in the world in terms of petrol. They also have gold and other things. And this is an interesting situation in that you have a self-proclaimed president there, a coup d'etat that many of the Western nations have recognized, and the person is doing it, Juan Guaido, is not in the presidential palace. He's at home in his flat. So a very, very interesting situation, a 2019 situation there. And then, of course, we have economic violence on the government of Venezuela. They have Citgo. Many people in the east and in the west, they have refineries around the American nation, in Texas, elsewhere. And the so-called government, it's not even a government in exile, it's a government in a flat, has arranged with the U.S. to get the funding. So the crude is not coming from Venezuela anymore. They're withholding it. And to make matters worse, there's 1.2 billion, 1.3 billion in gold, either in pounds or in dollars, in the Bank of England. And they are pushing that on. But what Venezuela has done is they now have bank accounts elsewhere in the Russian Federation. And what this is shaping up to be is a situation, because Venezuela's allies, China, has billions of yuans invested in Venezuela. The Russian Federation, which again has billions invested there, they are partnership also in the state petroleum company. So these situations are all there. They will have military drills. Where will all this go? Could this escalate into a war, an invasion of Nicaragua, and a civil war? And it could go also into Colombia, and you'd have these other parties involved, no doubt about it. The Russian Federation and is in Syria. More bases coming. The rocket forces, those planes that flew in last month that carry nuclear weapons. It's different from the Canada, the crisis during the late President John F. Kennedy. So we have all those things that eventually will translate into the economic pie, particularly in the world of macroeconomics. The winding down in the Syrian operation, the attempt to wind down in Afghanistan, and basically they are now in Moscow. The government is not in the talks, but the Taliban and the various others are there. They'll eventually settle that situation. And in the State of the Union, DJ Trump talked about these disruptive wars. That's basically my term, not his. But yes, they do take out of the national treasure. And various other things that are happening. It's snowing in Seattle. Normally in Seattle, I used to live there at one time in the 80s. There is more what we call an ice storm, and hopefully you're not on First Hill. But it was a different Seattle in those days. But now you have the snow. Usually you have snow out around Pasco, Spokane, out as you're going towards Idaho, that area. But we have that, and the wildfire, the damage that it caused out in California, and various other ecological disasters. That is now in the data sets of most forecasters, including the Federal Reserve. So more and more of this climate issue will come forward. The Arctic vortex that set in on the Midwest, but in Chicago they had minus 30, wind chills of minus 50. In Wisconsin, the upper Midwest, Minnesota, minus 30, minus 40, minus 50, and wind chills. We don't even want to talk about it. But those are some of the things, and the schools, businesses were closed. Even the Postal Service had to give up and take a rest for a day or two in many of those locations. So we're seeing more and more of those things impacting the climate, and we haven't gotten to hurricane and tornado season yet. So those are some of the things that are floating around out there. Let me get to switch workstations here. And Payless evidently is going into a new bankruptcy. The Payless source, as it is called, let me just see where it is here, prepares for bankruptcy that comes within weeks. The store closures there, more in the retail sector, weaknesses coming there from CNBC. The Payless Shoe Source, as they'll call it, apparently the second round of bankruptcy as part of the bankruptcy process. Payless is looking for a buyer for some of its real estate that could include large blocks of stores in certain areas of the country. If it can't find a buyer, it may need to shutter a majority, if not all, of the North American stores, a person said. Payless Source is preparing for a second bankruptcy, which will come as soon as within 2 weeks. The person cautioned that the plans remain in flux, and it's still possible that Payless could avoid bankruptcy filing, potentially by finding a buyer for the entire company. The retail sector has had all kinds of problems of late because of structural changes in the economy, going more and more to online situations. Payless filed for bankruptcy protection in April of 2017, closed 400 stores, and retailer currently has 2,700 in North America. Bloomberg first reported the Payless bankruptcy plan. If a filing were to occur, Payless would be the latest in a string of retailers to emerge from bankruptcy protection, only to boomerang back. So more of those coming there. And let me just more in the retail sector. The Tale of Two Toy Makers is also from CNBC. Mattel and Soars. Hasbro, that's the other toy maker, sinks, but there's more to the story. I would imagine so. Shares of Mattel, I remember Mattel even from my childhood, continued to soar after strong earnings on Thursday, while shares of Hasbro sunk, the result of poor earnings showing before the bell. And I guess I should date this. This was on Friday, the 8th of February. While a number of retailers, including Target and Walmart, and even drugstores, expanded their toy selection the past holiday, it wasn't enough to offset the hole left by Toys R Us. Industry-wide, sales of toys fell 2% in 2018. It's a miracle they didn't fall more than that. Investors rallied behind Mattel on Thursday after the company exceeded analysts' expectation during Q4. Shares spiked as much as 2.7% on Friday before retreating. The stock is down 6% over the past year, putting its value at $4.3 billion. Analysts expect renewed confidence in the company. Mattel's Q4 results were materially better relative to expectations, in our opinion. That is from David Crudum, an analyst at CFL. Incredibly more upbeat on business fundamentals. Investors and analysts were less confident about Hasbro. However, the company posted weaker than expected profits and continues to blame Toys R Us, the absence of Toys R Us, for their problems. We were surprised with the severity of the miss, but taken some solace in that the retailers' inventory levels have significantly declined. It should allow Hasbro to start 2019 with a relatively clear channel and more effective cost structure. Hasbro shares were down 4.9% on Friday after falling as much as 10% before the opening of the bell. The stock is down 11% over the past year, bringing its market value to $11.4 billion. Toys R Us effect, while Mattel has won this round in terms of gaining favor with investors, it didn't escape the fourth quarter completely unscathed from the loss of Toys R Us. The company's revenue fell 5.4% to $1.52 billion, and it did outpace the analyst estimation at $1.44 billion. The company said Toys R Us liquidation had a negative 8% impact on sales during Q4. Sales of Barbie and Hot Wheels excelled during the same quarter, but the American Girl doll sales continued to slump, and Fisher-Price and Thomas the Tank Machine toy, which were sold in Barbie R Us locations, fell significantly. So in other words, in retail, there still is a lot of problems going on. From Madame Lagarde, she is at the IMF, said oil exporters have not fully recovered from the oil shocks and cautioned against white elephant projects. Oil exporters have not fully recovered from the dramatic oil price shock of 2014. That's what she said, and so what she calls white elephant projects. Revenues are down. Fiscal deficits are only slowly declining despite significant reforms on both the spending and revenue side. In the introduction of VAT, that's value-added tax, and excise taxes. This could lead to a sharp increase in public debt from 11% of GDP in 2013 to 33% in 2018. That's what she told a conference in Abu Dhabi. Lagarde said uncertain in growth outlook for all exporters has reflected moves by countries to shift rapidly towards renewable energy over the new few decades in line with the Paris climate pact. Now, in Congress, Alexander Ocasio-Cortez, the Green New Deal, it's a non-binding resolution, but lays out a program for renewables, i.e. sun, wind, solar, etc. And in places like California and various other places, these types of energy are taking hold. Well, Bill Gates looking for nuclear power. That's just not going to happen. Saudi Arabia, the Mideast's biggest economy, has announced plans to go ahead with 3 major projects, including NEOM. That is a $500 billion economic zone announced by Mohammed bin Salman. The projects are backed by the country's sovereign wealth fund, the public investment fund that's been around. They hope to move that forward. The IMF revised forecast sees global economic growth by 3.5% this year, a 0.2% below what it expected in October. Unsurprisingly, a weak global environment has knocked on efforts on the region through a variety of channels: trade, remittances, capital flow, commodity prices, and financial conditions, she said. We see it a little bit different here. 3.5 is high, in our opinion, if you're talking about global growth. With modern industrialized capitalist countries, the Congressional Budget Office and many more have predicted the economic growth, at least in the U.S., around 2.3, 2.5%. That is providing there is not a recession, and we do expect a recession to appear in Q3 or Q4. It could appear earlier than that. How severe it will be very interesting. Now, in the event it does not appear, then that would leave open 2020, and it would become very, very interesting period. Let me just get the date on this article here. Oops. From the realm, we won't have the date on the article. It just disappeared here. Let's see. Fiat Chrysler paid 77. This is from Reuters. 77 million in U.S. fuel economy penalties in 2018. Told Reuters it paid 77 million. In the U.S., this is in civil penalties last year for failing to meet the 2016 standards. And this is on an administration that is less than officious when it appears that the National Highway Safety Administration said in a report dated on the 21st of December that the industry faced 77 million in fines in 2016. One unnamed manufacturer expected to pay significant civil penalties. Under federal rules, automobiles can accrue credits for over-compliance in some years. And the Obama administration finalized a rule requiring automakers to nearly double the fleet-wide efficiency of vehicles to more than 50 miles per hour. You're getting better mileage per hour. That is one of the things that is going on these days. Let me just check into the newest from Reuters while we're here. We already talked about the shifting of bank accounts in Venezuela. And let's see, what else do we have here? Oh, other news here. Amazon is exploring potential alternatives to their headquarters in New York. It is meeting with community grassroots opposition to it. So we'll see where that goes. There are other places that will give them, as they say, Amazon that is, substantial tax relief, tax credits, etc. And U.S. Here we go. See, this is where we're getting a lot of anecdotal information now. U.S. fund managers brace for consumer a slowdown with expectation of slowing growth, escalating U.S. fund managers, and this is from Reuters on the 8th of February. Consumer confidence has been going down. Lower U.S. Unemployment, rising wages could point to a healthy consumer, but worries about global growth, domestic U.S. politics, and China. Wall Street expects Q4 growth earnings at 14.7% for the S&P 500's discretionary consumer index, below the 17.8 consensus for October at the beginning of Q4. That's according to Renefine. I think that's how they pronounce the name. For the first quarter, analysts expect discretionary earnings to fall 1.7%, compared with expectation for 6% growth on October 1st. And you see these falls here. Consumer staples fourth quarter earnings are expected to grow at 4.2%, down from 6.7%. That was a consensus in October, with 0.7% expected for the first quarter this year. The broad S&P benchmark is expected to report fourth quarter earnings of 16.8%, a decline of 0.1%. That is not bad given the economic situation. Consumer confidence fell to a 1.5-year low in January as the partial shutdown there. That's according to the Conference Board. Sean Krevitz, Chief Investment Officer, said while the consumers remain generally robust, most people have something in their life in the past months that have given a poise. For the wealthy, it was watching the stock market go down 15% in Q4. That's what the Krevitz said. For government workers, it was weeks of no cash flow and uncertainty. For many, it was uncertainty over the shutdown and what the secondary effects might be to them directly to their jobs, their business, and economy. And didn't pop the bubble, but certainly a little bit of air went out of it. No doubt about that. Consumer discretionary index traded at roughly 19.8 times forward earning estimates, compared with 17.3 consumer staples and 15.8 multiplied for the broad S&P. You're paying more for less. That is from Burns McKinsey, a portfolio manager at Analyse Global Investments in Dallas. The firm holds stock in consumer companies including Target and General Motors, but is underweight the broader discretionary and staples sector. The company has yet to report earnings. The Department of Commerce announced this week that it would release December retail figures next week. That would be on the 14th. We'll be watching that very, very closely. A recent Reuters poll, a majority of economists saw the shutdown having a significant impact on a Q1 gross domestic product, with the median expected to be 0.3. On top of this, late 2018 equity market sell-offs, which sliced almost 20% off the S&P between September 20th and December 24th also scared consumers. That's according to Morgan Stanley. So this is back to some of not only the anecdotal but some of the data surrounding consumers, and consumers being over 70 to 80% of the American economy. As Vice President Biden, former Vice President Biden would say, it is a big thing. I'm cleaning it up a little bit here. We are in a situation where we're getting more and more economic reports, and they are not as what would happen. Normally in these kinds of situations, these small things, which we are not doing micro here, we're doing macro. But the small things and the way that the Fed has started to cast its data sets is more into categories at one time they did not analyze. Well, I guess we'll call it deeper dives. We at Cranston Analytics have been doing that for a very long time. And the inclusion of such things as climate, the course of climate, the polar vortex, etc., those things are starting to play in. So overall, we're getting a much better statistics than we had, or data sets than we had at one time. Definitely in the so-called Great Depression, the Depression of 2008. We're looking 10 years in, a decade. So things are better at detection than they once were. We have Dodd-Frank laws in place. They've only been weakened some, where the banks cannot, as they say, go on a binge. But the loosening of such things as payday loans, etc., those things impact the economy in a negative way. Because now what we have is more and more consumer debt, college debt. We have a lot of college debt out there. And although the graduates, by and large, are finding jobs, but the jobs, the readmittance, the wages for the jobs, are not enough to pay back for loans that they now have, and, as they say, to get daily things going. Let me jump back here to the people out in Mesa, Arizona, get them up. Oh, we're doing rather well on time for us. Oh, let's see. The Asian Review. We have Nissan and Renault alliance to join Google. This is on self-driving cars. This is from the Asian Review. This is something we've had up here for a while. This was early, the 6th of February. This is an alliance that plans to join Google's camp for developing what's called autonomous taxis and other services using self-driving vehicles. Nikkei has learned the automobile maker intends to work with Waymo. That is a Google spin-off in the technology sector. We won't spend a lot of time on Waymo, but Waymo is out there. And autonomous cars are coming. And we'll be looking there. Fiat Chrysler here. This is, let me see, when is this? On the 7th of February from Reuters. Shares fell 11% on Thursday after a week event. Expected a guidance on profits and industrial cash flow. I wouldn't put 2020 out of the picture. It's something that is very much there. That is adding that pending the launch of a new Jeep vehicle. They have the Gladiator and Ram Heavy Duty would save sales, but the sales are not good in the automobile industry. U.S. market remains a key for the near growth. That's from another analyst at Evercore. Let's see, who is he? House. Anyway, so we're still seeing problems here. The world's 7th largest car maker expects adjustments, more than 6.7 billion euros. This is below analyst expectations. and so we go with that particular situation. Let me get to the NRF. That's a National Retail Federation. The state of the economy is sound, and forecast retail sales will grow between 3.7 and 4.4. This is what today, and let me see, we got a date. This is on the 5th of February. Present to more than 3.8 trillion, despite threats from ongoing trade wars, volatile stock markets, and the effect of government shutdowns. These estimates are always a little above what they actually are. We believe the underlying state of the economy is solid. That's the president there, Shaw. Matthew Shaw. More people are working, more are making money, their taxes are lower, and their confidence remains high. Well, it doesn't remain high. The biggest priority is to ensure that our economy continues to grow and to avoid self-inflicted wounds. Preliminary estimates show that retail sales during 2018 grew 4.6% over 2017 to 3.68 trillion, exceeding the forecast there of at least 4.5%, including online and non-stores. We're up 10.4% at 682.8 billion. That met the NRF's forecast of 10 to 8% online growth, and is expected to grow the same again this year. That is kind of optimistic in our view, and we're not being pessimistic here. We're just giving the facts. Growth between 3.8 and 4.4 would result in 2019's sales being at 3.82 trillion and 3.84 trillion, based on a growth there of 10 to 12% online sales. The 2018 results were based on Department of Commerce data up to November, but it includes estimates from the National Retail Federation. We are not seeing any deterioration in the financial health of consumers. That's from their chief economist there, Jack Klinghelms. Consumers are in better shape than at any time in the past few years. Most important for years ahead will be ongoing strength in the job market, which supports the consumer income and spending both there. They expect the overall economy to gain on the average of 170,000 jobs per month, down from 220 in 2018, and that unemployment will currently at 4% will drop to 3.5%. By the end of the year, domestic product is likely to grow, and this is 2.5%. And we've seen a lot of 2.5% estimates from various people. Retailers so far have been able to largely mitigate the impact of the tariffs. Well, they're working on that one, particularly tariffs on 200 billion in Chinese goods rise from 10% to 25%. That'll be in March the 1st, actually. So that is there, and let's see where we're going here. This is the Supply Institute. These are the people, Institute for Supply Management out in Arizona, I believe. They were out there. Anyway, their PMI is at 56.6, and I'll just read it in Tempe. Anyway, it doesn't matter. This is dated on the 1st of February. A little bit old here. I guess we didn't get it in the last report. Not sure what's going on here. Anyway, economic activity in manufacturing sector expanded in January, and the overall economy grew for its 117th consecutive month. The report issued by the Institute for Supply Management Manufacturing Business Survey of the January PMI at 56.6, an increase of 2.3 percentage points from December reading of 54.3%. The new order index at 58.2%, an increase of 6.9% from a reading of 51.3 in December. Production index registered at 60.5% and 60.4% point increase to December's reading of 54.1. The employment index registered at 55.5%, a decrease of 0.5%, and we've been looking at that here. The suppliers delivery index registered at 56.2%, a 2.8% decrease from December's reading of 59. The inventory index registered at 52.8%, an increase of 1.6% from December reading of 51%. The price index registered at 49.6%, a 5.3% decrease from the reading of 54.9 in December. Comments from the panel reflect the continual expansion of business strength, supported by strong demand and output. Demand expansion improved, with the new order index reading returning to the high 50s. Consumer inventories index remains too low, and the backlog of orders remains at a near zero level. Consumption continues to strengthen with product expansion. Employment continuing to expand at the previous month's levels. Input expressed as suppliers delivering inventory and imports continue to improve, but are in a negative PMI situations. Exports continue to expand, but at lower levels since the fourth quarter. Since the fourth quarter of 2016. Prices contracted for the first time since Q1 of 2016. The manufacturing sector continues to expand, reversing weakness in December. Sort of a seaside going on here. This is Flore said here. Price include fundamental changes in supply chain and constraint. Of the 18 manufacturing industries, 14 reported growth in January, with the following: textiles, mills, computers, electronic products, plastics, rubber products, miscellaneous manufacturing of furniture, related products, printing and related supply activities, primary metals, chemical products, transportation equipment, machines, fabricated machine production, coal, and petroleum and coal. The only industries to contrast were non-metallic metal products. So this is the people from Tempe, their report. Kind of interesting here. We look at the PMIs and the various indexes at 56. And it's in January. It was 54 there. I won't go over this. We'll just append it. All right, here we go. See if we can scare up anything else. Weak outlook for consumer loans. Spending woes here. This was on February the 5th. A sharp drop in demand for U.S. autos and credit card loans points to a troubling question. Are the consumers poised to pull back despite surging growth? The shutdown there, and other economic indicators pointing to sharp drop in consumer sentiment. The Federal Reserve's survey of banks released on Monday shows that the net shares of banks reported weak demand for auto and credit card loans. A net 18.2% of banks surveyed by the Federal Reserve reported it's almost 20% weak demand for auto loans, and 17.4% reported a weak demand for credit card debt. So people are paying more cash. The drop in auto loan demand corresponds to sales in U.S. light vehicles, which dropped 10% year over year. As from Michael Pierce at Capital Economics, the Commerce Department has yet to report when it published data on retail spending. That was in December, but they didn't get it out. Motor Intelligence research has showed sales of new light vehicles slumped in January to a 16-month low. The automobile industry has been in trouble for the last several months, so there's nothing new there as far as they are concerned. We'll come back. We did Lagarde already, so we don't need to do that one. Now J&J became the first drug maker, this is from Reuters, to add prices to their TV ads. Johnson & Johnson. Johnson & Johnson said it will start adding the price of medications to their TV commercials next month, becoming the first drug maker to heed calls from DJ Trump. Their website, we'll see. Now, blood thinners here, I'm not sure. Most widely prescribed medication will be on the spot. The treatment used to prevent blood clots. It's $450 to $540 a month. Congress has had increased the scrutiny of this type of pricing. You'll hear more about this in the campaign to come up, period. Very, very expensive drug. Wasn't aware of that. There are some of those drugs that a friend of mine takes that's a generic, that's much Coumadin, I think it's called, is much less expensive. Now this is the January 19th Senior Loan Officer Opinion Survey on bank lending prices. I'm not sure if this is what we want here. Well, these are standard loans to banking. It's not, we weren't looking for, this is probably not what we were looking for here. So, let us do the numbers. We'll do it from the BBC. And let's get the data. We'll start with the FTSE. It was down 0.32. The FTSE, well, yeah, this is the FTSE 100. I don't have the FTSE all share here. Anyway, in Amsterdam, they were down 0.47. In France, they were down 0.48. It's in the negative. The Euro Stas was down 4.8. In Madrid, they were down 0.91. And in Bombay, they were down 1.15%. And Hang Seng actually was at 0.06%. And the Nikkei was down 2.1%. And if we go back to the Dow, it was down 0.25%. And all of these I was shooting in percentage. The NASDAQ was down 0.14%. And out in Chicago, they were down 0.7% there. And let me get the commodity prices up here. Brent crude futures at $62.10. That was up 0.76%. West Texas crude at $52.72 was up 0.15%. T-Boone Pickens still jumping for joy in retirement. And on the Forex, they were up 0.34 at $1,311.10. And that is that part there. That's from the BBC. We'll go very quickly here to Reuters. Yeah, we hope. Yeah. And the markets here and see what is going on here. See if we can find something we didn't find. Well, you never know. Yeah, basically the same program here. Markets, yeah. Nothing new there. Well. Now, we were hoping here to get the commodities, but we didn't get it, not from Reuters. We got the Nikkei and some other things here that we really were not looking for here. Let's see now. Well, we'll do commodities here. We'll see if we can get a little more from commodities than we previously got. And we're not going to get it. A little bit different here. This is in New York. This is the crude there. Was up 0.7 there. Change was 11%. And it was at $52.71. That's the New York situation there. The ICE Brent crude. I think we gave that one. Dubai crude on the spot there. $60.15. No change there. Home heating oil at $1.91. And the 10-year bond. This is the U.S. bond at 2.634. Yeah, for the 10-year bond. And we currencies. Well, so as they say. And key benchmarks. This is an interesting one. Here's something we can go out on. How Venezuela turned its useless banknotes into gold. Venezuela's most successful financial operation in recent years have not taken place on Wall Street, but in the primitive gold mining camps in the nation's southern region. The country's economy is in meltdown. Estimated 300,000 fortune hunters have descended on this mineral-rich region, panning gold, a new California gold rush. Their picks and shovels are helping to prop up the government. His administration, this is the Venezuelan administration, 17 tons of metal, around $650 million. With the country's newly worthless banknotes, these amateurs in turn supply the government with hard currency to purchase badly needed imports of food and hygiene products. The gold trade is a little bit different there. Trump administration pressured the Bank of England not to release. This is we talked about this earlier in the report. $1.2 billion in gold reserves. U.S. recently castigated Abu Dhabi based investment firm for gold purchases. Well, businesses there with the emergence in is the portrait of desperate experience in laissez-faire industrial policy. by the government there. According to Reuters, the formal mining sector has been decimated by nationalization. The Bulgarian revolution, has leaned heavy on ragtag laborers to do it. In other words, they are taking care of it, sells most of its gold to Turkey, and Turkey sells it on. So Washington has some scrutiny going on here, but gold fever's there. It's always happened in various countries, out in the jungle, I suppose, where it is. But not bad at all. This activity, let's see, is roughly 843 kilometers away. Gold does not stay there long. The central bank's gold reserves have plummeted to its lowest level in 75 years. So, they've been moving it on, but they have very large reserves. So the order from the U.S. government bars persons and entities from buying gold from Venezuela. In 2016, direct flights from Caracas to Istanbul, the development was probably given low demand for traffic. Well, they had something in mind evidently. New Year's Day, Venezuelan central bank begins shipping gold to Turkey. So Turkey is buying gold from Venezuela, and so forth and so on. And this is one of the things. It's an interesting situation here about the gold trade. One that we at this mic have been very skeptical of, but at the same time. And this is the individual gold trade. This is not the type of gold trade there. But in economically stressed times, gold has went back. It's not at the levels that it once was, but at the same time, it is at a level that they can profit off of. And those gold reserves, of course, the Russian Federation has huge gold reserves. So things are changing, period. In gold mining, you get into nations such as South Africa has a huge gold mine. So gold is out there, silver is out there, and one of the things we'll be looking at is how these sanctions, which we term economic violence, will affect the overall petroleum industry, and that's something we've been looking at, and where these people will be going. In the Yemenis, they have at 75,000 barrels per day. So all of this, these machinations where the U.S. Let's see. Let's look at one more here. This is on the 7th, so it's fairly recent here. All futures edge up. They have been edging up. We looked at this intermediate crude at $52, basically where it is, short of a 200-day average. These contracts here, the way they are going, and where Brexit will enter in on March the 1st, which is coming up in a week or two. We'll see where that goes. There may actually be no Brexit at all. We're ending the forecast here. We've done that. Anyway, about our average time here, we try to keep this under 50 minutes. For those in business, make next week a productive one as you start to eye a possible shutdown. For the consumer, the eyes have been on the prize, and consumers are weathering the storm and not evidently trying to access more credit card debt. It's a vast mix picture out there. Talking to some people that are involved more in jobs and job searches, it's a mixed market. There are people that are hiring, but many of those jobs are not the most desirable. They're in the $15 to $20 range, and depending obviously on which city a person is in, expenditures there are more or less balanced out. So there's not as much a discretionary consumer type situation. The American consumer during the holidays, there were a lot of discounts. They started discounting in November, some late October. So thus, I wouldn't look too much at these figures. I know just looking around over on Amazon, were not as many bargains there as they have been in previous years. But yet at the same time, last year, 2018, people did get their tax returns and got more refunds and got more discretionary income in there. They got some raises there. It'll be interesting to see this year if they're getting raises, and at the same time these redundancies are popping up. Most of them are fairly small, but if you look at the Fords of the world and the GMs of the world, they're both subtracting from the workforce. And in Chicago, I believe it's Ford, is actually adding workers. So in other words, you basically have 1,000 workers added, 1,000 workers made redundant, or 1,000 workers made redundant and 500 workers added. This is some of the larger corporations, and many others are in a restructuring mode, and this is expected to go on not only in 2019, 2020, and baby boomers, particularly in the federal government, after all of these shutdown operations, are looking at their situation and where their debt is. We expect them to recoup for what is lost, and perhaps in 2020, 2021, they will retire, that are eligible for retirement age, depending on the contract. And a lot of that will depend, a lot of workers, since 2020 is an election year, they will wait till after the election to euphemistically put their papers in. This will do it for us. Have a good week there, and good day.